Good evening, everybody. Welcome to the Town Pension and OPEB Trust Oversight Committee meeting. May I have a roll call, please?
Thank you and good evening. Councilmember Syock.
Here.
Councilmember Spector.
Here.
Councilmember Rennie.
Here.
Vice Mayor Jensen.
Here.
Mayor and Chair Leonardis.
Here. Can I ask everyone to please stand and join me in the Pledge of Allegiance? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. So we will move on to our first item, which is a consent calendar. Does any member of the committee want to pull either item 1 or 2? Seeing none. Anyone from public? Seeing none, we'll go for a motion on the consent items. Vice Mayor.
Move approval of the consent calendar consisting of items 1 and 2.
All right, I'll second. All in favor?
Aye.
Opposed? None. Passes unanimously. Moving on to verbal communications. These are for items which are not on our agenda. Does any member of the public wish to speak? Mr. Keowen.
A rainy good evening to you all. I'm amazed that everyone made it here. We have a little bit of traffic outside. Phil Keowen. Just real briefly, I think it's important that we have accurate numbers so that the council can deal with the pension issue. I'm referring to a staff report dated August 13th, 2018, where we're listing out for the public saying that additional discretionary pension funding to date was $16.9 million. And we have 3 items in here. The one that I'm focused on is the last, where we claim that we have $8 million in savings because of additional discretionary payments. And this is tied to this hypothetical 20-year amortization versus 30-year. I think it's really important to understand that no payments have been made to CalPERS as far as additional discretionary payment, none. So until that actually happens, you don't get the benefit of that payment in a shorter amortization schedule. So I don't want the council thinking that in reality, somehow we've banked $8 million of savings when we haven't done anything. All we've done is written a new general fund reserve policy that basically says, to our best of our intention, we hope and maybe we'll be able to put away $390,000 additional funds into this reserve account. But until you actually pay CalPERS, you don't get a benefit. So I think making that kind of statement for people who are just reading staff reports is terribly misleading, and I just think that we should do better than that. So I would ask that the council direct staff to correct this and really reflect the fact that the only savings that we've actually occurred is the $4.5 million sidecar fund that was paid off in 2013. Everything else has been just simply put into a 115 trust, which is up to now 3.3 million, but CalPERS hasn't seen a nickel of that. So the point being, until you actually pay the bank, you don't get the benefit. So I think we should be a little bit more crisp and clear around truly what's happened here. Thank you.
All right, thank you. Seeing no more speakers, we will move on to our first item in the staff report. Under other business, receive the presentation, accept the PARS Capital Appreciation Index Fund Q4 2018 performance report and account summary.
Thank you, Mayor and Oversight Committee. In our audience today, we have representatives from both PARS and Highmark Capital, and they will give a brief overview of the presentation that you have in your packet.
Good evening, Mayor, members of the council. My name is Nick Vigant, and I'm going to actually be referencing, it was made apparent to me that you guys have this presentation in front of you, so I'm going to be referencing page 2 to begin with, the contacts page. Just really briefly, I'm Nick Vigant. I am stepping in for your normal client service coordinator from PARS, Jennifer Meza, and then also with me this evening is Andrew Brown from Highmark Capital Management. Going on and turning to page 3, just a quick overview again. I know this is going to be familiar for a lot of you, the PARS Trust team. I'm going to be obviously representing the far left column, PARS. We're going to be your day-to-day administrator and also mainly keep up on top of plan compliance and any kind of actuarial coordination. The middle column is going to be U.S. Bank. They're going to be your plan fiduciary and trustee. So any kind of contributions or reimbursements are always going to be going through U.S. Bank. And those $3 million, a little over $3 million that you guys have contributed has gone to the depository through U.S. Bank. And then lastly, on the far right-hand column is going to be, again, where Andrew Brown is representing Highmark Capital Management. They're going to be your investment selection and your investment manager. So he's going to be working directly, obviously, with you regarding that capital appreciation investment. Moving on to page 4, a little summary of the pension plan itself. Again, it's going to be a discretionary approach with Andrew Brown and Highmark Capital Management. There have been $3.3 million of contributions to date, and then at the very end, this is going to be as of 1/31/2019. We have just about $3.3 million still in the account as of right now in the plan assets. And then lastly, before I hand it over to Andrew Brown, I just wanted to go over page 5, the summary of the agency's pension plan. Just going to be an overview, a graphical representation of the contributions and disbursements and total assets from the plan inception date. So I just wanted to show you guys that and break that down for you per month. So with that being said, I will just hand it over to Andrew. Thank you very much.
Thank you.
Good evening, Town Council, staff. My name is Andrew Brown, and I think I've heard my name mentioned like 4 times in the last 3 minutes. So it's just not me at Highmark Capital Management. There's 53 of us managing about $15 billion in assets under management. We're a subsidiary of Union Bank, and we have been in business for 99 years. Next year we'll be celebrating our 100th anniversary, primarily working within the Union Bank framework, but Highmark Capital Management is more than just me. I wanted to give a brief update on the plan for the first, 10 months of inception. The things that I want to discuss are on the discussion highlights page, which I show as page 7. Typically the main things that I want to review in a meeting like this, and being respectful of your time, I think it's going to be about 5 or 6 minutes. Asset allocation, the investment objective, a little bit about performance, and maybe a quick 90-second, 2-minute thumbnail sketch of where we see the economy and the markets may be heading. The investment objective, something we call capital appreciation, which really refers to an asset allocation model that ranges for stocks between 65 to 85%, bonds 10 to 30%, and cash can range from 0 to 20%. So with any one period of time, we're going to have a worldview, and we'll have some positioning within those asset allocation ranges. Currently, right now, we're at 76% within equities, 22% bonds, and 2% cash. We try to stay diversified across all asset classes, and so specifically within the stock segment, we have an exposure to large cap at 40%, mid cap 6%, small cap at 12%. Internationals right now at 16%, and REITs are at 2%. Nick mentioned that we are on an index-based platform. That is what the town selected, so all the underlying investments are all index-based. A little word on the investment objective, capital appreciation. As the name infers, it's a growth-oriented investment objective, and certainly as the asset allocation supports, it's focused on growth. Commensurate with that, though, will be some volatility. The bad type that we saw in October and in December, and the good type that nobody really seems to complain about in January. But yeah, we will have some ups and we will have some downs, and so that should certainly be expected. Maybe not to the extent that we saw in December and January, but those aren't necessarily 100-year flood type of events. You're not the only client that has selected the capital appreciation investment objective, so don't think that the town's out on a limb. But it is a small fraternity of our clients, and roughly 150, 160 that we have in the pension pre-funding platform. Maybe about 10% have selected capital appreciation. And so if I think about the clients that have selected that, the towns, the cities, the special districts, some of the commonalities that you'd see would certainly be a growth orientation. You want to grow these assets. You have a stomach for volatility, because you'll see the ups and you'll see the downs. All of the clients have strong underlying financials. So the notion of, geez, how are we going to pay that CalPERS pension increase in fiscal year 22-23? That's really not a topic for debate for these clients that have selected capital appreciation. And certainly time horizon. Even though these are pension assets, long-term in duration, a lot of clients have decided to work with us as more of a budgetary stopgag sort of measure, in as so much as, they look at the 5-year projections of their financials and they say, when our pension rates go from 4.8 million to 5.4 million in fiscal year 22-23, not sure how we're going to fill that gap. But we do have some money now, so Highmark, you have a 3 to 4 year window to manage these assets, and then probably in 22-23 we're going to take these assets and we're going to send it off to CalPERS. And so with that, it's not really a 30-year sort of horizon, it's more like a 3 to 4 year horizon. So sort of refreshing all the dynamics that at least were in place when we were doing our due diligence, those were some of the factors that played a role in, I think the town selecting capital appreciation. So in as much as we get together once or maybe twice a year, I just wanted to kind of focus on that, because that's an important dynamic. Performance is also an important dynamic, and we only have 10 months of numbers to show, but it's been an eventful 10 months. And this is designed to be a quarterly investment review, and so you'll even notice that I kept the December 31st, 2018 title page as designed to be a fourth quarter number. But yeah, I mean, January was eventful on the upside, so I thought it would be a good service to show the town what January delivered, but I certainly kept the fourth quarter numbers in here. And January was a positive to the extent of 6.19%. That's what the pool capital appreciation index delivered. For the 3-month period, 1.82, and then inception to date starting April 1st, 2018, 0.53. You'll notice the designation gross of fees here. Within the pool, the investment management fee is 35 basis points for the first 5 million of assets under management. The town has 3.3, so if we took 10 months of 35 basis points, if you wanted to get an approximation of a net number, you'd want to take about 30 basis points off that 0.53, giving you 0.23. So barely above zero, but it's a smidge in the positive. So if you wanted to get a net number, that's what it would be. Just very quickly, fixed income, with our experience over the first 10 months of working together, the Fed's raised rates 3 times. We're of the belief that we might be towards the 8th, maybe 9th inning of a Fed rate hike regime, which the good news for us is that, maybe we can start make some money at a fixed income. But some money in our estimates is maybe 3.5–4% over a long-term period of time. If we've been working together for the last 7 or 8 years, we probably have an annualized 2% run rate for fixed income segments. So certainly the low interest rate environment has impacted fixed income returns. With 10 to 30% in bonds, it's not going to be the big driver of total returns for this investment objective. It's the 65 to 85% that's invested in stocks that is, going to deliver the growth. That 65 to 85%, at least over the last 10 months, certainly has been impacted by the Fed. Many investors we're a little bit uncertain as to in terms of some of the signals that the Fed was giving off. Under new management with Jay Powell, at times he gave off a very hawkish vibe, and markets reacted very negatively in October and December, and then kind of did a U-turn there in January, and well, we saw what January yielded in terms of stocks. Also, some of the things that have impacted us, certainly China, trade skirmish, trade war, whatever that morphs into. I'll lope politics, Washington, D.C. into one element. Certainly Trump kind of makes it interesting from time to time. But things like the midterm elections and, oh, by the way, government shutdown, that's also some of the things that we've experienced over our first 10 months working together. The outlook, just for a quick thumbnail sketch, some of our clients say, hey, the recession's coming, we know it. Well, not from our standpoint. We don't see a recession. We see a bit of a slowdown in growth. 2.1 to 2.6% GDP is our estimates, and yeah, it might be closer to the 2.1% side, but has a two-handle, and it does, from our standpoint, it's not a recession. Inflation, we see it low, 1.9, 2%, so we don't see the boogeyman of inflation getting out of hand, and probably that's one of the reasons why we don't think the Fed is going to be inclined to be raising rates too vigorously. In fact, our prediction here is 0 to maybe 1 hike in 2019. And then the last bullet point I put down here, 2020 elections, it's probably a little bit too early to start worrying about that, but you're going to start seeing some speeches here in the summer, and to the extent that a candidate emerges as maybe a leader who might have some unfriendly market behaviors, well, then that's something to probably think about, but it's certainly too soon to act on it. So, I tried to throw a whole lot in there in 5 or 6 minutes. I hope I hit on the major things that you wanted to hear. Questions?
All right, questions for Mr. Brown. Mr. Rennie.
Thank you, Mr. Mayor. So let's say at some point you see a high probability of a recession coming. So you have your dials would be to knock the stocks down to the bottom of the range, right? 65% probably, and then knock up the bonds or the cash. Is that what you would do if you thought? Is that what we would expect to happen to our portfolio if you started getting quite sure a recession was coming?
If the firm felt that the recession was coming, we'd be going to the lower end of the equity range. But good point, because 76 to 65, you don't really move. I mean, you don't move to a different zip code of risk. I mean, it's not a whole lot of difference. But to answer your question, yeah, that's kind of the arrow in the quiver. Yeah.
And you might move maybe around the large cap, mid cap, small cap also. Is it better to be in one of those if a recession is coming? Better to be in large cap maybe?
Well, I think we would want to see the global mosaic, the landscape. Because right now, if you look at the last 10 months, our international has lagged considerably. So maybe in our view, if we saw a recession coming, international has been hit so badly over the last 5-6 years that maybe that's where we would put a fair amount of that 65%-ish allocation to. But there's so many variables.
The real question is, you would do something different if you thought that the market was changing.
That's the real question. That's the real answer. But the underlying answer is 65% in equities still doesn't give you a whole lot of Kevlar, right?
Okay, thank you.
Any other questions? Seeing none, thank you, Mr. Brown. We have Mr. Cohen.
Thank you.
I don't think you're going to like what I'm going to tell you. The good news is the staff got this one absolutely right. They made a recommendation for the town to invest in a moderately risky investment portfolio. What you have chosen is the highest octane risk portfolio that this company offers. And you don't have to look any further to see back in October of 2017 when they came and made their pitch, they told you that this fund, 5 years, annualized return was 8.39%. Roughly 19 months later, they're now telling you it's 4.81. If you look at the annualized returns, this fund has only been around since 2009, and it's ranged from a negative 5.8 to a high of 23.7. The volatility around this thing is massive. And you have to ask yourself, what is the business purpose we're trying to solve here? And I think the idea is to be able to put aside money, and the bet you're making is that somehow this fund is outperforming CalPERS, which, by the way, their 5-year net return, net of all fees, was 5.1%, so that's not happening. But the bet was that somehow you're going to give it to this fund, you're going to outperform CalPERS, and 3 to 5 years later, you'll take that money and pay it to CalPERS. As fiduciaries, it's your job to think in terms of the beneficiaries here. That's who you have to be thinking about. And I don't know what argument you can tell a beneficiary that you've taken money and put it in the highest risk category that they offer, betting that somehow you're going to outperform CalPERS when the actual data shows they're not. So I don't know what you're achieving here, other than it's clear to me that you want to play stock market roulette. I'll also say, if you look at the Bartels report, they have a sheet in there where they talk about the 115 trust, and they show you a very logical way to use it. If you look at that sheet and you look at the rate of return on that sample, it was 5%. Not trying to dial up 9.1 that this fund does. So you have a real mismatch here. And I urge you to rethink this. The staff was right. You should do what they asked you to do.
Thank you. That was the only speaker for this item, number 3. So this item was, I think, informational only. Does council have any other comments or questions for staff at this time? Seeing none. Vice Mayor.
Procedural question. The recommendation is that we accept the report. Do you want a motion that says we accept the report?
That would be correct. It's accepting the quarterly
right.
report.
So I would move that we accept the report that we received.
Second. Discussion. We'll go with Councilmember Sayoc.
I'll quickly support the motion, but I just want to ask staff, given the accuracy of your recommendation a couple months ago, what should we're receiving this presentation, and if you can give me a context of what I should be doing with this information. Is it something that I'll be needing for a decision in the upcoming future? Can you just give me some more context on what I should be doing with this?
It's part of what's stipulated in the investment policy that was adopted, which is it's prudent to at least quarterly just see what the performance of the assets have been. One quarter does not make a market, and so by a quarter to quarter, we are not asking you to infer anything. It's more just being in a fiduciary capacity where you're just staying cognizant of the assets and the performance that's accruing quarter to quarter throughout the years.
Okay, and then if I can, a follow-up. So when is the appropriate time? I understand your comment that quarters are too short a period, but as a financial advisor, what would you recommend the longer period of length before we start to need course corrections, if any?
I think it's there's also information in here that shows benchmarks. So
Okay.
I think it's definitely relevant to look at performance versus their own identified benchmarks. It's relevant, to look at their performance relative to their own expectations. Usually we view this stuff through an annual lens, and it's only about 10 months in. So on an annual basis, you can then start to see, are they meeting their own predetermined benchmarks? Are they meeting their own, verbalized expectations? There was a little bit of a market outlook provided today. How correct is the outlook? Are they making the right assessments in the marketplace, the way they're viewing the marketplace?
Okay, thank you.
Councilmember Spector.
Thank you, Mr. Mayor. Question of staff, probably Mr. Andrews. We are receiving the presentation and the report, and I've asked this before. I will be supporting the motion, but receiving meaning that we've read it, we've heard what has been said. Is that what you mean by receiving?
That is, it's a term of art that I picked up when I was CIO at my other pension plan, and receiving meaning that you're acknowledging that you're in receipt, you looked at it, and then also you're accepting it, that you're saying this was our fourth quarter performance based on their information for the quarter.
Thank you.
Vice Mayor.
That's what I intended by the motion, nothing more. But in a follow-up to Councilwoman Sayak's questions, I know that item number 4, not to get ahead of ourselves, is review and provide direction on additional discretionary payment, which is not the same as changing your investment strategy. So I'm not sure how far afield the council could go on number 4 if it decided based on information to do that or not.
And that would be correct. Number 4 was intended for informational purposes only because there's been an ongoing dialogue. And so this is, just providing additional information. The council has indicated that in the upcoming budget, there probably will be money set aside for additional pension payments again. And this is information as you head into that decision matrix. If you do set aside additional monies, do you have an inclination or a preference of additional strategies, different strategies, or just adding to the existing strategies?
Okay, so item 4 is informational as well, and if we want to take any action, that's at our next budget meeting. And when is that?
Well, I think the budget meeting would give the indication of the amount of dollars we're talking about, and then at the next oversight committee, or even if there's the bandwidth to move through the finance committee, starting a discussion about, would whatever the identified surplus monies are that the council would like to be put towards additional pension mitigation strategies. Is there a different direction, an additional direction, or would you like to pursue the same direction?
Okay, thank you.
All right, thank you. So we have a motion and a second. I'll call the question. All in favor? Aye. Opposed? It passes unanimously. Thank you. We'll move on to item number 4.
Thank you, Mayor and Oversight Committee. We started to speak to the topic a little bit. The item before you today is just additional information because over the course of the past year, whether at the Finance Committee, this Oversight Committee, or the Council, there continues to be interest in additional ways that this Council can address the unfunded pension obligations. This Council historically started moving in a very proactive direction in 2009 when you moved forward with funding a 115 trust for OPEB assets. That 115 trust was a vehicle to provide additional discretionary payments above and beyond the pay-go, which we were doing historically for our OPEB unfunded obligations. Then the council took one step further and said, let's establish a 115 trust for our pension obligations. At the time, part of the reasoning was diversification away from CalPERS, asset allocation, a place to have additional monies in the event that people wanted to pursue additional strategies. And then also it was just a way to continue to accumulate assets. And so to date, this council has shown a strong inclination to utilize one of the various strategies available to you. I will highlight that the scenarios that are provided in this staff memo were intended to be illustrative only. It's to show you the types of strategies and mechanisms that are out there, with the one exception of the 115 trust, where there was work done, especially as we move towards the different amortization strategy. There was work done with CalPERS to come up with that solution. One of the other areas that we've talked about in the past and in our audience today is Joe Dionforio with Bartel and Associates, was when Bartel gave a presentation, they also at the back of their presentation showed some additional ways that you could achieve, additional ways to mitigate the unfunded obligations. And one of the things they talked about is the concept of pension contribution kind of mitigation strategies where you take additional payments towards pensions, you put it aside either in a 115 trust or in the town's own pension and OPEB reserve account. And then for illustrative purposes, I just put our 5-year forecast in there. If the council were inclined to say, well, we don't want our pension payments to go above this number it could be the 5-year forecast period, it could be a different period, you put the money aside, and then each year, as the pension contribution payment from CalPERS comes due, you've got these extra reserves to provide a little bit of extra capacity on the expense side in your budgetary decisions. One of the other things we've talked about is the idea of actually giving monies directly to CalPERS. That can be done in a couple ways. It can be done through just giving generic funds to them and it would be dispersed throughout the unfunded liability, or we can actually look at specific amortization bases and target them. Both strategies try to achieve a shifting down of the anticipated cost curve. Bartel's presentation and other presentations have shown what we think the cost curve for our pension payments is going to be out into the future. This would be a way, and I caution saying all things held equal, that you would shift the cost curve down. And so the example there was just illustrative also to say, if you give additional money at that point in time, you will shift the cost curve down. And if you want to pick specific amortization bases, you can kind of pick to a certain extent where on the cost curve you want to try and get a little more shift down. I will say, and the staff report says this, in both the pension contribution stabilization strategy and also monies directly to CalPERS, staff wouldn't recommend giving those monies directly to CalPERS at this time. The reason we state that is because we think there could be future better opportunities for market valuations. If you think about giving monies directly to CalPERS, it's almost the same concept as a pension obligation bond in the sense that this town has self-funded an additional amount of money to give to CalPERS. So there is a little bit of point in time market risk associated with when you give that money. When you give it, you do receive the benefit of reduced interest. You do receive the benefit of reduced contributions. However, if the market dynamics move against you, that will quickly be erased when you get your next valuation. With that, we are available for questions. Myself and, as I mentioned, Joe from Bartell is here if you have any questions regarding his presentation, which was attached, or any of the information in the staff memo.
All right, thank you. Questions from council at this time? Seeing none, we will go ahead and open the public hearing and come forward, Mr. Terry Derrier.
Hello. Here is in this really pretty intimate setting, given the lack of participation by the public, as both a resident and a member of the Finance Committee. My following comments are because I care about the town. They reflect a combination of intellect and feeling. The feelings come from the frustration that I sense about the process being used to address one of the town's biggest risks, its obligation to fund the long-term pension and OPEB commitments the town's made. The town's other major risk is fire. I think those are the two largest ones. Yet the probability of the town not being able to meet the employee retirement commitments while maintaining the quality of services far outweighs the probability of a risk of fire. As I said, I'm here because I care about the town. I don't represent a neighborhood. I don't represent a special interest. I don't represent a group of merchants. I don't represent a group of residents or the staff. I'm here to do what I believe is the best for Los Gatos. I appreciate Mr. Andrews' explanation of what the purpose of item 4 is, or of the item 4 memo is. It offers two simple alternatives, so staff, as I can paraphrase, can hear from council if they would entertain other ADP strategies. Each alternative includes a staff recommendation to keep any ADP money identified to fund the town's pension obligations in the town coffers, earning short-term money market yields while the actuarial assumptions assume the monies are earning 7%. Both staff alternatives present a short-term analysis for a long-term problem, with the staff using the short-term analysis, the short-term viewpoint, to justify keeping the money in the town coffers at money market rates. Both alternatives dismiss the richness of the Finance Committee discussions over the last 18 months that preceded the town council decisions to put money in a 115 plan. I'm not saying I agree with the decisions in hindsight that were made, but at the time, the decisions were felt to be the best decisions. The analysis does not address the pros and cons of using PARS versus in the 115 plan versus CalPERS. The discussion and decision on how to fund the town's pensions commitments does not address the UAL. It doesn't bring about critical thinking or thought that is reflected in a 5-page memo of the biggest decision, the biggest risk the town has at this point.
Mr. Derriere, we have to conclude your comments.
Okay,
We
well,
have-
I'll give you a summary comment if that's okay. It's a short one. I'm going to make two of them, and if you have to give me the hook, you can. It looks, in summary, it looks to me like the town council did not, because the town council did not adopt the staff draft resolution at the January 15th meeting to narrow the finance committee focus. The staff memo is an attempt to end run around the finance committee. I hope I'm wrong. The last comment I would say is if you're looking for active participation, 3 minutes is not a way to have a dialogue. Thank you for listening.
Thank you. Jack Von Nader. And then the last card I have is Philip Cohen.
I'll jump to slide 4. Good evening, Council. Jack Van Naden. This is more of an executive summary, but about the only thing I can squeeze into 3 minutes. What I would like to do is take a look at the ADP paydown of $6,900,000, which we've suggested in other meetings. You can see, whoa. Well, let's see. Could you go back one more? Oh, I got it. There. Right there. You'll save, with this 12-year amortization program that was given to us by CalPERS, that you'll save $8,484,000 over this 12-year period. $1,584,000, which is interest that you won't be paying. What can you do with $8,400,000? You can reinvest every year's cost reductions into payments of the pension debt, which is my choice. 2, you can hold on to it in a town account. In that period of time, in 5 years, you could have $4,485,000. In 10, you would have $7,650,000. You can use it for operating costs, business improvement district, etc. To me, this is the ultimate flexibility. What is my concern about PARS? PARS has never experienced a major downturn in the market, yet the return is only 4.2 to 4.6% net of fees. CalPERS for the same period was 5.1%. When the town really needs the money in PARS, we may be in a down market. The largest decline in the market was 57% in 2008 to 2009, and the market was down for 517 days. The second worst decline in the market was 49% from 2000 to 2002, and that market was down for a record 929 days. Why would you choose CalPERS? 1, Bartels recommends it. 2, the staff recommended it. CalPERS survived the 2 biggest downturns in the last 50-year stock market history. It's a much bigger, more seasoned organization than PARS. The annual reductions are guaranteed for the time period specified in the amortization schedule. We tested the 6.9 scenario with CalPERS, and our numbers were spot on. So, gotta remember, I gotta multitask here, I'm not too good at it. What's next? Statement has been made that the decision on PARS has been made, implying that it's best to stick with PARS. I disagree. We think that flexible thinkers know to make a change when there's a better scenario. One last thing. In this fast-changing world created by the internet, information flows fast and furiously. This solution, as presented, may have a better solution tomorrow and will change with anything that improves the pension payment dilemma. Thank you.
Thank you, Mr. Von Nader. Mr. Rennie has a question for you.
Thank you, Mayor. Could you go back to page 4? I didn't understand those numbers. I guess the first part of the question is, what are we supposed to be saving if we pay down CalPERS? It's supposed to be 7%, right?
I can only tell you that the numbers right here, this 897 that you see for 6 years, comes from CalPERS.
Yeah, when I look at the percentage, that's 13% of the money we put in. So if that's what I'm not understanding is how are we saving 13% when the assumption is a 7% return? So why are we saving 13% instead of 7%?
I can't give you the mechanics of that without having CalPERS explain it. Maybe Mr. Bartels, or not Mr. Bartels, but maybe Bartels could explain how that happens. But these are the numbers that were actually verified by CalPERS when we send it in. So first year we get 897, second year we get 897, all the way through 6 years. Then it drops to 617, then it drops to 417.
Somehow it doesn't make sense to me, but I guess we'll have to find out.
It comes from CalPERS.
Okay,
Yeah.
thanks.
All right, thank you, Mr. Valneda. Philip Cohen.
Can everyone see this? Can you read it? Okay. A couple of things I want to leave with you. Number one, you have no option. You have to pay CalPERS the unfunded liability. Can we all agree on that? Oh, what happened? You didn't like what I'm saying, so I got cut off. So you have no option. You have to pay this. The strategies you're talking about are all around how do I defer it, you know, how do I play some stock market gain to try to make a little bit more money. But in reality, and Bartels will tell you this, the single best thing to do is pay it off if you have the money to do it. So I called up CalPERS and said, what if we paid off a couple of amortization bases? And Arn talked about that. The unfunded liability payment that we have to make this year is $2.3 million. And it consists of a whole bunch, think of a layer cake, a whole bunch of amortization for different gains and losses. So depending on where you are in that time period, you can pick and choose which ones to pay off. So in this instance, these are the ones I chose to pay off. A base from 2003, a base from 2007, a base from 2009, a base from 2011. Those go away. You make a payment of $6.9 million. You don't have to pay the $2.3 million this coming year. You only pay $1.4 million. You've just saved yourself roughly, what, $900,000. And if I heard the 5-year budget, you're telling me that we're going to have budget deficits beginning next year, which indicates to me you don't even have enough money to pay the 2.3. So what is so hard about this concept? Here is an opportunity for you to take $3.3 million that's sitting in this PARS account. We know we have another at least $3.6 million in the capital project reserve account. You have enough cash. The sensible thing to do is to pay it off. One last thing. There's a lot of confusion about, well, if you give the money to CalPERS, there might be a future loss. Doesn't matter. If you pay them or don't pay them, whatever happens in the future will happen. So what would you rather have? Pay off these bases, pocket $900,000 less that you don't have to pay next year, and if there's a correction in the market, guess what? Yeah, you're going to have to pay more because that's the way it works. Or go ahead and try to make the $2.3 million, which apparently we can't do because of the 5-year forecast, and you're still going to have a loss. It doesn't make sense to me. This is the single best opportunity for the town on a cash flow basis to be able to start plugging that $1.5 million budget deficit that we told is going to happen next year. And this is the letter from CalPERS. You have it. Steve was given a copy of it. I'm kind of mystified why you're not talking about this, since this is the trustee group for all of this. So I really urge you to consider this. Thank you.
Thank you. Questions? Seeing none, that's the last card I had. We'll move to council for discussion or motion. Vice Mayor.
It's a question. Same thing I asked before we started the discussion is when is the appropriate time for us to discuss changes, if any?
Well, this evening, we wanted to provide to you an opportunity to discuss some of the other options or other strategy to your avail. We have not provided any staff recommendations in this memorandum. It was purely to lay out those additional strategy. We do have staff from Bartell Associates who are here if you have specific questions about their previous material, and it's my recollection that there was not a recommendation coming from Bartell as well. So really tonight we're just looking to see whether or not the council would like us to explore any of these other ideas. If not, that's fine too. So we're not looking for a motion, but just rather if you have any interest in us doing further analysis on any of the additional strategies. Thank you.
Thank you.
And if I may just correct the record for a second, staff brought this forward because during the 5-year forecast, we were asked to bring it directly to this body. And as the town manager mentioned, it purposely doesn't have recommendations. Staff is not necessarily saying to deviate from the course of the 115. We're just trying to educate this body as fiduciaries that there are additional options out there that we could pursue, not necessarily to unwind the option we're already pursuing.
We're going to go with Councilmember Spector.
Thank you, Mr. Mayor. In reading the staff report, I started with the review and provide direction on additional discretionary payments, and that's what I was looking at as I prepared for this evening. And two things. In giving my thought to this issue, I was not looking, or the one before, I was not looking at timing the market or market conditions and chasing them. I was not doing that, one thing. Secondly, we received today from Ms. Pravetti a document called City Manager's Department Pension Sustainability Working Group. I think that's an excellent document, and I commend it to the council and to the community. Now, having said that, I think that we have heard pros and cons on the 115 trust. We have heard pros and cons on payments to CalPERS, and new information to me, at least in the past several months, has been not general payments to CalPERS, but directed payments to CalPERS. That's a new piece of information. And so in giving my input this evening, if I were God of the world, I would send this issue of re-examining the 115 trust and the CalPERS directed payments back to the Finance Committee with the presentation by Mr. Bartell, and then have all that information come back to this council. So that's what I would like to see.
Councilmember Sayoc.
Councilmember Spector pretty much summarized what I was going to suggest. I'd like more information from staff about this directed payment. I know we talked about it at our last meeting, so I'd like to know the pros and cons of the directed payment versus the general lump sum. It's intriguing, and I see it as another option in the various ways that we're trying to address this.
Vice Mayor.
I had a question and a comment. Again, would somebody remind me that the Finance Committee met about this very question and determined to put money in the 115 trust, correct? And then since then, we've heard from various other members of the community that that was the wrong decision. Is that what happened at the Finance Committee? That's why the council chose to put it in the 115 trust? And I'm looking at Mr. Andrews, and Mr. Rennie can certainly say what he's going to say.
And that would be correct. The Finance Committee has recommended continually that at least right now, during this point in time, during these discussions with the monies that were available, they wanted those monies directed to a 115 trust as opposed to CalPERS.
Okay, and so then my comment is I agree that I would like more information about direct payments to CalPERS. I also agree that and commend the city, whatever they're called, the report that Ms. Spector held up. It was very good, very interesting, and gave a lot of different commentary on strategies that should be taken, legislative and also financial. So I would like more information on directed payment, and I would like more information about how much money there is to do that and when the staff thinks it's appropriate to do that, given Mr. Andrews' earlier comments on when to put money in.
Councilmember Rennie.
Thank you. So I just wanted to kind of set the record straight for what I remember from the Finance Committee. And what's been said is not accurate, what we've heard from the public. The purpose of putting money into the 115 wasn't to play roulette or try to get a better return. What was said in the Finance Committee was we would expect the returns to be the same given the same asset allocation kind of funds. The reason to put money into the 115 fund was, well, it is a form of diversification, so you have more than one. But more importantly, your funds are more flexible this way. If you put the money into CalPERS, you can't get it back, and you have to continue paying whatever the amount is that CalPERS requires you to pay each year. When we put money in the 115, council at any time can decide this is a really bad year, we're having a really bad recession, we owe $8 million to CalPERS. We could pull it all out of the 115 and give relief to our budget. If you put all that money in CalPERS instead, you can't say, oh no, CalPERS, we want more of it to apply this year when things are really bad. So that's a huge advantage to having it in the 115 if you assume that the returns are going to be more or less the same. And we haven't seen enough of the PARs to really know, are they that much worse than CalPERS? And I think the asset allocation isn't, well, I think we heard last time, isn't exactly the same. I think we're a little more weighted on equities in our PARs, which means you certainly can't compare a 10-month period to see if you're going to get the same thing. So setting part of the record straight.
Any more discussion on this item? So at this point in time, staff knows we have general direction, or would you like an official motion to wrap this up?
I think the direction is pretty clear, and that's all we were seeking. You know, do you want us to engage with Bartel to run through a few scenarios of if we tried to target different amortization bases, what would the outcome be? Because there's a couple ways you can approach it, just real quick. If you go for amortization bases further out in time, you'll get greater interest savings, but you'll get less contribution relief. If you go for closer in, you get greater contribution relief and less interest savings. And so we'll bring a few scenarios to the next Finance Committee for them to look at.
Excellent. Okay, so any other comments or questions on this? Seeing none, we'll adjourn this meeting. Thank you.